This is Sara with Global Pulse, and I want to slow everything down for a moment because what just unfolded in the markets is not normal, not routine, and definitely not something that should be brushed off as just volatility. Over the last few days, we witnessed an extraordinary collapse across gold, silver, and the crypto market that erased an estimated $15 trillion in combined value. Let that sink in. $15 trillion didn't disappear gradually over months. It was wiped out in a shock event that played out in real time. Gold fell roughly 15%, which on its own would already be considered extreme. Silver was hit far harder, plunging close to 40% at the lows. At the same time, the crypto market unraveled almost in sync. Hundreds of billions of dollars vanished in hours, and more than $2 trillion worth of leveraged positions were forcibly liquidated in a single day. Bitcoin dropped sharply, erasing roughly $260 billion from its market capitalization. Ethereum fell even faster, wiping out over $90 billion. XRP and other major tokens followed the same pattern. This was not selective selling. This was a broad liquidation wave. What makes this event so disturbing isn't just the scale of the losses, but how coordinated and fast everything happened. Statistically speaking, moves like this across multiple asset classes are supposed to be extraordinarily rare. Yet we just saw metals crash, followed immediately by crypto collapsing. That tells us this wasn't just about bad headlines or changing sentiment. This was a liquidity event driven by leverage, margin pressure, and stress inside the financial system itself. Let's start with precious metals, because that's where the chain reaction really began. Late last week, silver experienced one of the most violent crashes in modern market history. Trillions of dollars were erased from the paper value of precious metals in a single session. On the surface, some blamed macro factors like dollar strength or policy expectations. But when you look closer, the mechanics tell a much more uncomfortable story. Margin requirements on silver futures were raised sharply. Traders who had been comfortably positioned suddenly needed to post dramatically more collateral just to stay in the trade. Many couldn't. Forced selling kicked in, not because investors wanted to sell, but because they had no choice. When forced liquidations hit a thin market, prices don't drift lower. They collapse. At the same time, large institutional players were able to close positions right near the bottom, while over-leveraged traders were being flushed out. That pattern is familiar. Weak hands are forced to sell under pressure, while deep-pocketed players step in quietly when prices are distressed. What's even more striking is what happened outside the paper markets. While silver prices were collapsing on futures exchanges, physical markets in Asia refused to follow. Buyers in key regions simply would not sell at those prices. Physical premiums surged, in some cases exceeding 40% above paper prices. That kind of disconnect is extreme. It signals a breakdown between paper pricing and real-world supply and demand. That creates a dangerous setup. When forced selling clears leverage and short interest is reduced, but physical supply remains tight, the next move can be explosive. The market doesn't need bullish news at that point. It just needs the selling to stop. Now let's talk about crypto, because the same dynamics played out there over the weekend. Crypto saw multiple waves of liquidations totaling more than $1 billion in a very short period of time. This event now ranks among the largest liquidation episodes in crypto history. Again, this wasn't about fundamentals changing overnight. It was leverage colliding with thin liquidity. Crypto had become extremely crowded with leveraged positions. When prices started to fall, liquidation engines kicked in, forcing automatic selling. That selling pushed prices lower, which triggered even more liquidations. It became a self-reinforcing loop, creating the kind of straight-down price action we just witnessed. There is a key psychological level markets are watching closely in Bitcoin. A break below certain thresholds would put some of the largest institutional holders underwater on paper. That doesn't automatically mean forced selling, but it does matter psychologically. Markets care deeply about those levels, especially during periods of stress. When you compare this liquidation event to past crypto crashes, the magnitude becomes clear. It's larger than several infamous collapses and sits near the top of the historical list. And the timing matters. This didn't happen in isolation. It happened right after the largest metals crash on record. That raises a very serious question. Are we seeing contagion, or was this a deliberate reset? Here's another layer that cannot be ignored. While markets were imploding, the news cycle was saturated with distractions. Political scandals, geopolitical threats, and sensational headlines dominated public attention. Money doesn't simply vanish. When $15 trillion is erased from asset prices, it changes hands. And it often happens when most people aren't watching closely. Geopolitics added fuel to the fire. Tensions in the Middle East escalated rapidly, with troop deployments and warnings making headlines. Markets hate uncertainty, and when geopolitical risk spikes suddenly, investors sell risk assets first and ask questions later. In the early phase of a crisis, everything gets sold. At the same time, the first U.S. bank failure of the year was reported. One bank alone doesn't bring down the system, but history shows that crises rarely start with the biggest institutions. They start at the edges. In 2008, smaller failures came first before the stress spread. When liquidity tightens, weak balance sheets are exposed. This is why, here at Global Pulse, we're saying clearly that what we're seeing looks less like a routine correction and more like system-level stress. Trillions of dollars were wiped out in minutes. That is not healthy price discovery. That is a liquidity shock. So what happens next? There are two very different paths forward. In the bearish scenario, this is the start of a broader liquidity crisis. Asian markets open first, and if they gap sharply lower, the tone is set globally. More margin calls follow. More forced selling hits metals, crypto, and equities. Confidence erodes further, especially if additional banks show signs of stress. In that environment, even gold and silver can fall again as investors scramble for cash. Safe havens don't always behave like safe havens in the first phase of a crisis. In the bullish scenario, this was the flush. Excess leverage was wiped out. Shorts were covered. Weak hands were shaken out. Physical demand stayed strong. If Asian markets stabilize and crypto liquidations stop, confidence can return quickly. When selling pressure disappears in a market with reduced short interest, rebounds can be fast and violent. We've seen this before. A brutal collapse followed by an explosive recovery. Physical fundamentals remain strong. Crypto can bounce if key levels hold. And if geopolitical tensions ease, risk appetite can return faster than many expect. So what am I watching as Sara here on Global Pulse? I'm watching Asian market opens. I'm watching physical premiums. I'm watching Bitcoin's behavior through the weekend. I'm watching headlines around geopolitics and the banking sector. Those signals will tell us whether this was a controlled reset or the beginning of something much larger. For those following global currency shifts, including Iraqi dinar developments, moments like this matter. They expose the fragility of the financial system and the difference between paper claims and real assets. They also remind us that leverage is unforgiving. This is not a time for hype. It's a time for discipline. Margin calls don't care about your beliefs. Liquidity events don't wait for clarity. Whether this becomes the opportunity of the year or the opening chapter of a deeper crisis will become clearer very soon. Stay sharp, stay logical, and keep your eyes on the data. This is Sara with Global Pulse, and we'll be watching every move as this story develops.